Welcome back to Sethtra Academy, where we decode the laws that turn money into mastery. Let me start with a truth most investors ignore. Wealth is not built by picking winners. It's built by balancing risk. The rich don't make money because they take more risk. They make money because they control it. If you look inside the portfolios of great investors from Ray Dalio to Southeast Asian family offices, you will find one invisible pattern: the 60-30-10 rule. It's not magic. It's not luck. It's balance, the invisible force that keeps wealth alive when everything else falls apart. In finance, return is a reward, but risk is the price you pay to earn it. Amateurs focus on how much can I gain. Professionals ask, how much can I lose and still stay in the game? The 60-30-10 rule isn't about greed. It's about survival with strategy. It was born out of decades of data from hedge funds, pension systems, and disciplined investors who noticed one thing: too much safety kills growth. Too much aggression kills peace. Only balance builds legacy. Here's how the 60-30-10 principle works. 60% is your stability zone. These are your low risk, predictable assets: government bonds, large cap stocks, real estate, or index funds. Their goal? Protection and consistency. 30% is your growth zone. This is where you allow for movement: mid-cap equities, emerging markets, or real estate investment trusts. Their goal? Expansion and opportunity. And 10% is your speculative zone. This is where innovation lives: crypto, startups, art, or high-risk sectors. Their goal? Evolution and potential. Every portfolio, from billion-dollar funds to family savings, must live within this balance. Why? Because every empire that grew too fast collapsed the same way from unmeasured risk. Imagine a farmer in Kampong Cham who owns 10 hectares of land. If he plants all 10 with a single crop, one drought could destroy him. But if he plants 6 hectares with rice, 3 with fruit, and 1 with high-value spices, even if the weather changes, something will always survive. That's the same wisdom behind 60-30-10. It's not about maximizing yield. It's about ensuring you never run out of soil to plant again. The farmer's goal isn't to win once. It's to stay alive to harvest again. And that's how the wealthy think about investing. In modern portfolio theory, risk is measured by volatility. When you split your assets across different levels of volatility, you reduce your exposure to a total collapse. When one sector crashes, your other assets act as shock absorbers. When one opportunity skyrockets, your base capital remains stable. Mathematically, it's called non-correlated balance. Psychologically, it's called peace of mind. That's why the 60-30-10 rule outperforms most gamblers. It builds calm, not chaos. Of course, no two investors are the same. The rule isn't fixed, it's flexible. If you're young, with time and ambition, your ratio might be 50-30-20. If you're older and prioritizing peace of mind, maybe it's 70-25. The formula adapts to your age, goals, and temperament. The key isn't the exact numbers, it's the discipline behind them. Even with $500, you can live by this principle. Because wealth isn't a number, it's a system of decisions repeated with intelligence. When Warren Buffett builds his empire, he doesn't bet everything on one play. When Singapore's sovereign wealth fund invests, it doesn't depend on a single country. They all apply the 60-30-10 principle in spirit. 60 for protection, 30 for growth, and 10 for evolution. That's why nations stay rich while individuals panic. Because systems don't feel fear. They function by design. Risk allocation isn't just financial, it's philosophical. It teaches patience. It builds humility. It respects uncertainty. When you build your portfolio using the 60-30-10 principle, you're saying, I don't need to know the future. I only need to design for it. And that mindset, not the math, is what separates the smart investor from the emotional spender. So how can you start today? First, calculate your current exposure. What percentage of your money is truly safe? Second, rearrange intentionally. Build a structure that reflects your goals. Third, automate your contributions and let your portfolio grow quietly. Finally, review it every 6 months. Adjust without panic and never chase the 10%. Let it serve your 90%, not destroy it. Your 60% protects your family. Your 30% grows your dreams. Your 10% builds your future. Wealth isn't about how much you can make. It's about how well you can manage uncertainty. And at Sethtra Academy, we don't just teach finance, we teach financial architecture. If you found value in today's lesson, hit subscribe, join the movement, and keep learning how to build balance before wealth. This is Sethtra Academy, where knowledge becomes wealth and structure becomes freedom.